Now, the talk is investing during a recession. And from your introduction, I find that the majority are older people like me who are retired or running a small business. So I'm covering 6 topics. Investing for retirees, investing in 2023, that's next year, where most people expect a recession and a falling stock market. Then I will talk about recession, interest rate, and the stock market. Next, I will talk about investing in gold and silver, and then cash shield insurance. I added another topic, investing in property, because that seems to be still a matter of great interest. And after that, we have questions. So during my talk, if you have, please mute your audio. If you have any question, feel free to type in the group chat, and I will answer them at a suitable time.
Group chat.
Okay, so let me see. I will pause. So if you have any question, please type in the group chat. I will answer them at a suitable time. Now, investing for retirees. During the past 15 years, it has been extremely difficult, and just because of the low interest rate. The interest rate has been extremely low. For several years, it was less than 1% per annum if you put the money in fixed deposit. And most people find that not sufficient, so they have to take some risk in order to earn a more decent income on their savings. So they take some risk by investing in stocks, even in some bonds. Now, bonds are generally safer than stocks, but still is also could be quite risky, because if you buy the bond of a company, the company can go bankrupt. And some investors have actually lost a lot of money buying the preference shares and the perpetual securities. These are the bonds of a company called High Flux. So bonds can also be quite risky. But actually, the biggest risk is scam. Many people invested in what turns out to be scams. And the scams, under the scam, they lost all their money. Examples of scams are plentiful. I've come across so many scams from time to time. And quite recently, many people lost in FTX, the crypto exchange. They put their money in the exchange, and now all their money are gone. So it was a scam. The money was misused by the exchange operator. So there are so many scams around, and that's actually a very big risk. But retirees got no choice. They don't get a decent return on deposits, so they have to look for other forms of investment, and they bought stocks and bonds of poor quality or lost their money on scams. Now, the most important factor for retirees during a difficult time is to be prudent in spending. While they are looking for ways to get better return on their money, which can be difficult and risky, an easier way is to be prudent on spending. What are the areas? Transport. Many people still maintain a car, which is extremely costly. especially if you are a retired person, if you're an older person, there's no need to have a car. Many car owners say they can't do without a car. And I think that is not correct. They have not tried to make the adjustment. So if you give up your car, you can save a few $100s or $1,000 a month. So this is one area to be prudent. Another area is medical expenses. Why? If you go to an expensive specialist in a private hospital, it can be extremely costly. And it's better to go to a government polyclinic where the cost is quite affordable. Sure, the private doctor, specialist, or private hospital might be a bit better, but the difference is not that much in terms of the treatment. But in terms of expenditure, it is a lot. So I find that many people who can't really afford it spend too much money on medical expenses. Or they buy insurance to cover the medical expenses, and the insurance will be very costly. So if you are not that well off by being prudent in transport, in medical expenses, it's easier to manage. Those are, I think, more important. You can't do much with earning better income, but you can do quite a lot in controlling your spending. Some people do have sickness, quite serious sickness, and they want to find a way to cure it. Now, I think that for most people, once you reach the stage of being very ill, and if you cannot be treated in the public hospital, it's quite likely that a private hospital can't do much for you anyway. So if you can't really afford the expenses, don't waste your money. So those are my tips. I find, let me pause a while. Now, recently we find that the stock market has dropped. So I want to just share with you what happened to the stock market. The S&P, these are the American stocks, which these are the blue chip, the big companies in America. Now, it has dropped by 16% during the first 10 months of 2002. So a 16% drop is a very big drop. But if you look over a 5-year period, you will find that the return is actually 49% over 5 years, in spite of this drop. So this is a drop. So the return over 5 years is 49%, then that works out to an average of 8.4% per year. So investing in stocks over the long term, if you are willing to forget about the fluctuation up and down, over the long term is still quite good. So the return on S&P is 8.4. And then the technology stocks under NASDAQ, it dropped 32% this year, which is a very big drop. But over the last 5 years, the return is actually 9.9% per annum. So the return on technology stocks is actually better than the blue chips under the S&P. So the point I want to make is do look at stocks investing over the long term and don't worry too much about the short-term fluctuation. Next are the China stocks. Now, the China stocks over the last 5 years actually dropped by 10%. So China stocks looks comparatively worse, poor compared to America. But that is because the China stocks have been undervalued. The price-earning ratio, the price you pay for China stocks is less than half of the US stocks. So later on, I will explain that most of my stocks are invested in China, not in America, because the price are very attractive. They're not expensive relative to the earnings of the these China stocks. The price are quite low. I do expect in the future the China stocks to recover quite considerably, so that you don't have this kind of situation where the last 5 years American stocks are doing very well and China stocks actually suffer a drop. I think this will be corrected. My preference is still for the China stocks. So I'll now talk about investing in 2023, and many people expect that there will be a recession. What happens in a recession? In a recession, companies will report profit drop. The companies become less profitable, and when the profit drop, of course, the share price drop. Now, another factor that will lead to the drop in the share price is high interest rate. Now, when interest rate is low, stock market goes up, and when interest rate is high, the shares, the stocks will drop in price. And 2023 will be a year of high interest rate. So therefore, you're going to see the stock price will suffer from two factors. One is lower profit, and one is high interest rate. And in such a scenario, you have to be very careful of highly leveraged stocks. These are the stocks where the company has borrowed a lot of money for their business. And what they borrowed, the interest rate has increased. So the interest charges will be very high. And the highly leveraged stocks can go bankrupt, and many have done so. In China, you must have read about this Evergrande property developer. They are highly leveraged, and the stock is virtually bankrupt. So there are a few companies that are highly leveraged, which cannot survive the recession. So be very careful. But for those blue chip shares, those that are not highly leveraged, it should be all right, because they can weather through the storm. What is highly leveraged? I look at the ratio of debt to equity. Debt means bonds, borrowings. And if the ratio is less than 70%, it is okay. If it's more than 70%, you have to be careful. If it's more than 100%, that means their debt, their bonds, the borrowings are more than the equity, the shares, then it's very highly leveraged. So in a recession, you can still select good quality stocks which are undervalued, that pays good dividend. If you look at some of the stocks in America, most of them are quite highly priced, and the dividend are not attractive, maybe 2% or less. But if you look at the China stocks, many of them are very attractively priced, very low stock price relative to their earnings, their profit, and they pay very good dividend. So I will introduce you to some of them later on. But now the interest rate is now quite high. Last year, if you put the money on the bank deposit, you earn less than 1%. Now you can earn more than 3.5%. So if you buy bonds, you can earn maybe even higher. So with this higher interest rate, it's now a good time to put some of your money in bonds. So I will say 40% in bonds, 60% in stocks, ETF, and in gold. And the stocks, you can still choose stocks of good quality company, undervalued, paying good dividend. And ETF is an exchange traded fund, and these funds are usually invested in good quality stocks. So instead of buying individual stocks, if you buy ETF, you are actually spreading your money into the stocks in the fund, in the ETF. And usually there will be 10 or 20 stocks, good quality. So the ETF is a good way. And then investing in gold might be a good time. So this is probably what I would consider to be a good formula for 2023. Now let me just pause and see whether there are some questions I need to address now. Okay, there's a question. Should I downgrade my integrated shield plan? I will answer that in the question of insurance. Another one, will S&P recover over the long term? My preference is not American stocks, which mostly highly valued. My preference will be the China stocks, and I will cover that later on, why I prefer the China stocks. So the S&P, I think it is mostly still quite high. So the correction hasn't brought it down to an attractive level. The next question, how to buy gold in Singapore, will be covered later on. Okay, I'm now going to continue to the next slide. So I'm going to talk about recession, high interest rate, and the stock market. Now, we know that interest rate in America and in Europe has gone up very high due to the Ukraine war, but mainly also largely due to excessive money printing during the last 3 years in America and Europe. So there are too much money, which has led to high inflation. Of course, the Ukraine war has made it even worse. And to bring down inflation, which has now gone up above 7% in America and in Europe, the monetary authority, the US Fed, as well as the ECB, Europe Central Bank, raised interest rates to very high levels. Well, not so high at this time, about 4%, but it's expected that it may go up further. So when they raise interest rate, they want to curb demand to reduce the spending. And this high interest rate will bring an economic recession. And the stock market will drop due to recession, which means lower profit, and due to high interest rate. So these remarks I make are mostly for America and Europe. They do not apply to China. The reason is the interest rate in China is not high. And also the stock prices in China is not high. Of course, the stock prices in China is depressed because of this COVID. The zero COVID policy has been very badly depressed. Many people quit the China stock market. I did not. I held on to my shares. And right now I'm seeing the China stocks are recovering very well. Generally in Europe and America, the stock market will drop due to the recession and high interest rates. So if you are fully invested and you have little cash, you are suffering from a drop in the asset value, in the stock prices, and even bonds have dropped in price. Those who invested in long-term bonds, 5, 10, or 15 years, the price have also dropped a lot. US government bonds of 10 years duration dropped by 30% this year. We all know stock prices have dropped 30% or more, so have the bond prices. So if you're fully invested, you just have to accept that your asset values have dropped. And those who are highly leveraged in stocks and properties, if you borrowed a lot of money from properties, or you invested fully in stocks, you may find that you become quite squeezed during next year, 2023, and you have to liquidate some assets, stocks or properties at big losses. So the position for next year is not encouraging, and many people hold this view because they are fully invested, highly leveraged. In my case, I invest only with money that I don't need to spend, I don't need for spending. So I'm actually quite comfortable. I don't worry too much because I'm not highly leveraged. I don't have to pay mortgages. My properties are fully owned. My stocks are invested with money that I have, not with borrowed money, not on margin. But most people are highly leveraged, so they may be feeling being squeezed. This is the US Treasury bond yield. In 2019, the yield was at 3%. Then during the pandemic 2020-2021, it dropped to as low as 0.5%. Of course, during this time, the stock market boomed, asset prices went up, technology stocks went up a lot. But then interest rate starts to go up to 1.5%, which is still okay. Then it's gone up to 3.75%. And it's expected that it might go beyond 4%. So during this time, 2022, the stock market, the bond market have dropped by 30% or more, because of this high interest rate. Of course, if you have cash and you want to invest to earn the yield of 4% on treasury bills, bonds, or Singapore government treasury bills, you can earn 4%, it becomes quite attractive. But when it was at 0.5%, it was not attractive. It was better to invest in stocks. But now it's time to invest in treasury bonds. Now, how to invest in gold? If you go to the American stock market, you got some ETF, exchange traded fund, that are invested in gold, or you got a silver ETF. So I think that is actually quite a good way to invest in gold. Now, when I talk about US stocks being highly valued, those are the stocks, but the gold ETF represents the value of gold, or the silver ETF represents the value of silver. So you can invest in the ETF. The ETF themselves are invested in gold. and in silver. So this would be the good way. Maybe later on I will show you where are the gold ETF. Now the other way is to invest in physical gold and silver. So I got a friend, a doctor, he's in his above 80 years old. He knows a place in, I think, Suntec City. He gave me, introduced me to that place. I will go with him next time to visit this company where you can buy physical gold bar like this, and bring it back home and keep it at home. So some people like to invest in physical gold or physical silver. You must bring, must drive there and put this in your car because it's quite heavy. So you can invest in physical gold or silver. But for me, I find that quite a hassle. After you got this physical gold or silver, you still need to keep it somewhere. I would prefer to invest in the ETF. Another way to invest is in miners. That means companies that do mining of gold, mining of silver, or mining of other precious metal. So these are companies that are in the mining business. These are stocks. So that's another way. Now the gold price so far has been quite steady for 2 years, which was quite disappointing, because when it went up from 2018 to 2020, middle of May, I was expecting it to go all the way up, gold become 3, 4, 5,000. It did not. It did not. It actually went down about 10%. Was quite surprising. I expected to go up because we know that the US government have been printing money, and that will bring about inflation. When there's big inflation, people will rush into gold. It has not happened yet, but I believe it will happen. And I believe that now is the time it may be happening. So just watch out carefully. It may happen because now more and more people are now quite worried about US dollar collapse. When US dollar collapse, gold will shoot up. So it has not happened the last 2 years. And in fact, I have lost 20% or 30% on the stock, the gold mining stock that I bought. And even my holdings of gold ETF has gone down about 15%. So you have to be patient. I'm going to buy a bit more now because I do expect the US dollar to be in big trouble. I've been following the news about several countries, China, Russia, and other countries, making plans to move away from the US dollar as a reserve currency. And when that happens, the US dollar will drop by a lot, and I think gold will go up. So this is my view. And this is also the view expressed by many traders. It has not happened yet, but I think these kind of things will happen. When it happens, it can move up very fast. Okay, let me see if there's 3 more questions. I think Victor Fu said you can buy physical gold over the counter from UOB. And there are many bullion houses in Singapore where you can buy gold bars. But purchasing directly from UOB gives you an option to sell back the bars to the bank. So Victor says UOB is a way you can buy gold, you can sell it back to them. Christine asks, should we surrender the policy in US dollars if US dollar is projected to go down? It means insurance policy in US dollars. Of course, this doesn't apply to insurance policy. It applies to other US dollar investments, such as the treasury bonds, the US stocks, and so on. Now, the thing about US stocks is this: if US dollar goes down, their stock might be still all right, because the stocks are invested in companies, and when US dollar go down, the company might show bigger profit in US dollars, so that might be offsetting. But if you are invested in US dollars in bonds or in insurance policy, then the US dollar will be a bad investment if it goes down. But so far, it's very hard to tell. I expect the US dollar to go down in 2022 because of their big deficit. Instead, it has gone up. It went up by 10–15% against other currency. And that's because US dollar now pay higher interest rate, and people rush to buy US dollar for the higher interest rate. But this is, I think, temporary. Later on, something breaks, something happens, US dollar turn around, it drop, and then it can drop very fast. So these are very hard to tell. I think many people find it quite strange that US dollar is so strong this year when they are running a huge deficit. Many of the experts actually think that US dollar will collapse quite soon, but it has not happened yet. Okay, so now I talk about cash shield insurance, and also talk about somebody asked just now whether you should move from integrated plan to basic MediShield. Now, for cash shield insurance, now this is actually for long-term disability where you need nursing care. So these are people who cannot move about on their own. They need a nurse to take care of them. They are on a wheelchair, and they tend to be older people in their 90s, late 80s or 90s, who move about in a wheelchair and need a nurse to bring them around. But in order to be able to claim for this cash shield, you need to not only use a wheelchair, but you are not able to take care of yourself, to feed yourself, to bathe yourself, to dress yourself. So these are more severe. And when that happens, the cash shield insurance will pay maybe $600 a month for a number of years. I don't know whether it's now for the whole life or not. Now, I personally find the cash shield not attractive because the payout ratio is low. The insurance company now is all transferred back to CPF. CPF collect billions of dollars every year, billions, but the payout is only 9%. 91% is not paid out. It is the payout ratio is very low. It's quite difficult to make a claim. I myself don't like cash shield insurance, and if you have a choice, maybe it's better you keep the money in your MediSave rather than buy cash shield insurance. So let me show you the 9.4%. Now, this last 3 years, the cash shield insurance was operated by a few insurance companies. But from this year, they are all transferred back to CPF. So in 2019, 557 million were collected in premium, paid out only 60 million, 10.8%. Then next year, 7.7, next year, 9.8. The average is 9.4%. Of course, I must explain that the premium you pay 10 years of premium to cover for a whole lifetime. So therefore, you don't expect the claim to be very high in the early years because you're paying 10 years of premium to cover maybe an average of 30 years or longer. So a payout ratio of 10%, it means that a large part of the premium you pay is reserved for future years. So it could be equivalent to maybe about 3 to 5 times the claim payout at 10%. If you consider that the premium is partly maybe 2/3 of the premium is for the future, so the payout ratio will be 30%. If you assume that a higher percentage, let's say it is 40% is for the future. No, I mean the 4/5 is for the future. Then the payout ratio can become 50%. Still, 50% I think is low. So I do believe that the insurance, the premium is too high relative to the claims, even allowing for this payout ratio. So even allowing for the fact that the premium is to a large extent for future years, I think still from my calculation, it's not attractive. So I would avoid joining CareShield insurance or opting for the supplement. That means buying additional insurance similar to top up CareShield. I would avoid that. Okay, so that's my view. So there was a question asked about integrated plan. I think I will give a separate talk about the integrated plan, but I will just answer it briefly here. The integrated plan, should one give up integrated plan to move to the basic MediShield Life? Now, if you are retired above 65 years old, you will find that the integrated plan can cost 3, 4, 5 times of the basic plan. If you are well off and the 3, 4, 5 times is something you can afford, then by all means continue. But if you find that that 3, 4, 5 times, which could be several $1,000s a year, is something that is you can't afford, then it's best to move to the basic MediShield Life operated by CPF. But I will give a separate talk to explain the calculations in more detail later on. I will now talk about investing in properties because I read the views of many people and also the financial articles by financial experts on properties. And right now it's quite clear property prices continue to rise due to demand from foreigners, from Hong Kong, from China. So some people are moving from China, from Hong Kong to Singapore, and they buy expensive properties, private properties, and that in turn, the locals sell to them, and then they move to HDB, and HDB price have gone up. So there is a higher property prices due to this current surge in demand. Sure, this is true, but I want to point out that when the market is rising, most owners hold back their sale. They wait for prices to go up further. This happens all over in many countries, not just Singapore. Market is going up, owners don't want to sell, they hold back their property, they want the price to go up further. Now, what caused the property market to drop is when there's an increase in supply. And the increase in supply actually come from owners who have to sell because they cannot service their mortgages. Because of higher interest rate, the mortgage payment has gone up, and many owners can't service, they have to sell their property. Of course, they sell their investment, the second property, their investment property, but they may also, some of them even sell their primary property, the one the owner occupied, because they need to get some cash, and then they themselves will go into the rental market. So when there is an increase in supply, the whole thing tip around quite completely. Suddenly, the buyers virtually disappear because the buyers then say, the prices have fallen, I will wait for price to fall further. So when that tipping point occurs, and I think it will occur in 2023, maybe 2024, when mortgages become more expensive, 10–20% of owners may find a squeeze, and some will have to sell their properties. So when that happens, the whole thing turns around. We are already seeing this in America. Recently, I saw an article in Australia, and I even saw an article written in Singapore of how a young family bought 2 properties using all of their income, and then they find that the mortgages had gone up 20–30% due to higher interest rate, and they have to sell. And when they sell, they are caught with this seller stamp duty. So it's very bad. So Singapore is not that safe. So I just want to give a caution that when supply increase, the property price will drop. This has happened in some countries. Singapore will not be an exception. I don't believe that the Hong Kong, China factor can prop up the Singapore property prices, because there's in the rising market, most people think property is a great investment. They don't sell, and the few buyers will push up the price. When the price turn around, the property market drop, the whole supply demand equation will change. So that's my view. I find that property prices are far too high all over the world, and even in China, it's too high. That's why the China government decided they have to take action to bring down the property prices. Okay, now the last 10 minutes, I'm going to show you why I like to put my money in China stocks. No, most of my investments are in China stocks. This year, it has done poorly. I'm down about 20%. And I'm not worried at all because of China stocks. The earnings are very good and the prices are so cheap. It's unbelievable. So I will even take out my additional cash and put in China stocks. So these are the China stocks that I follow. Sinopec is oil company. China Railway, you know, the railway system in China is the best in the world, and so many people travel on the railway. ZTE, this is a chip company, CHIP, semiconductor. China Mobile, I think they're the largest mobile operator in China. China Sundian, this is solar panel, green energy. SMIC, semiconductor. This is the largest semiconductor company in China. They make the semiconductor chips. Dyna Green is also like Sundian, is in the green energy. That means solar panels and those green energy. PICC, People's Insurance Company of China. This is the largest insurance company. ICBC, Industrial Commercial Bank of China, is the largest bank in China. Costco is Costco Shipping, the largest shipping company in China. This is a holding company. Ping An is another big insurance company in China, similar to PICC. Ping An was privately owned. Of course, it's listed in the stock exchange. Costco Shipping Development. I think this is a subsidiary of Costco Holding, and this one takes charge of the ports in other places around the world, and also rent out containers. Costco Shipping Energy. This one is a subsidiary of Costco, and they are transporting oil and gas. These are the all these are listed in Hong Kong, and the same stocks are listed in Shanghai, and the price in Hong Kong has a discount of 29%, 35%, all the way up to 73% compared to the prices in Shanghai. That means if you pay $100 in Shanghai, you only pay $27 in Hong Kong for this stock. The discount is 73%. Ping An, no discount, it's the same. In fact, Hong Kong is 1% higher. But all the other stocks, the average discount is about 40%. So imagine now DBS in Singapore, let's say it's $40. You can buy DBS at 40% discount. That means you pay $24 instead of $14. It's almost like that. If you got a 40% discount, the same stock that you buy in another exchange, you can get all this discount. So basically, I'm happy to buy the stocks because of this big discount, because I believe one day the discount will disappear. When that disappears, the stock price will go up. In the case of this SMIC, it will be 3 times just for the discount to disappear. If the people in Shanghai are paying 3 times the price and the people in Hong Kong pay 1 time, it will become 3 times, a matter of waiting for that to happen. So one of the reasons why I buy the China stocks is this big discount. When I buy them, the discount was not so big, but because of the China stocks have dropped due to the COVID lockdown, the discount become bigger, which means it's cheaper. If you believe that the lockdown will one day be removed sooner or later, then of course the prices should move up. Not fully for the discount to disappear, but at least to be reduced much more from here. Next, I want to show you the price-earning ratio. That means this company, if it's Sinopec, if they earn $1, you pay $5.90, 5.9 times of what it earns. And you take a look at Costco Holding, you're paying a price equal to 1 year of profit. I don't know whether there's something wrong with this figure. I haven't got the time to check. I think 1 year something is not right. But if you take a look at ICBC, it's 3.6 times. That means if they earn $1, you pay $3.60 for that share. Let me tell you, ICBC is 5 times the size of DBS of Singapore, DBS Bank. DBS Bank in Singapore, for every $1 of profit, you pay $13 for the share price. So you pay 13 times of their profit. And in ICBC, you pay 3.6 times. What this means is ICBC is 3 to 4 times cheaper than DBS. I believe that this is much better deal. 3.6, China Railway 3.5. See, it's very cheap. Costco Development 3.4. I believe this is correct. See, I bought Costco Development when it was maybe 4 times of the PE ratio, 4 times, and it's dropped to 3.4. So what I invested actually dropped 20% from 4 to 3.4. But if it go back to 4 times, then I will recover. It go back to 5 times, I will make 25%. So it's extremely cheap. So anything that's less than 10 is actually cheap. Sinopec 5.9, cheap. China Railway cheap. ZTE, okay, not so cheap. China Mobile is okay. Because if you look at Singtel PE ratio is 30 times. China Mobile is 8 times. So again, Singtel, China Mobile is 3 times cheaper than Singtel. China Sungtian, SMIC. So all these are very attractive. Costco Engineering, again, this is not correct. I don't think it's as high as this. But if you want to study, you have to study, but if you're not interested, just ignore it. Look at dividend yield. Sinopec Oil Company, you can get 15% dividend. Costco Holding, 38%. Again, Costco Holding, the figure may not be correct, but anyway, Costco Development, 25%. Of course, dividend yield, if the company profit drop by a lot, they're going to cut the dividend. If they cut dividend by half, then of course you won't get 15%, but you get 7%. But 7% is still very good, even if they cut dividend by half. So therefore, I actually would be quite happy to invest in China stocks for 3 reasons: the discount, the price-earning ratio, and the dividend yield. Now, this is the highest price over the last 52 weeks, and this is the current price discount over the highest price. So most of them, except for Costco Holding, which is only half of the highest price, most of them are about 60–70%. China Sungtian also half. So this is what I think would be I would pick on these stocks to invest for the recovery, for the getting out of COVID. I already hold many most of these shares, and although they are down 20%, it doesn't matter to me. I've been sharing in my Facebook, also in the Fiscal website, my investment in Country Garden. It's not listed here because it's not. It's in Hong Kong, but it's not in China. So I didn't put it down here. But Country Garden, maybe later on I will share. I also invested in Ping An and Country Garden recently. I think it's the last 2 months. And because I bought these stocks at very low prices, they have recovered 20–30%. So I do make quite a bit of gain in these 2 stocks. Okay, so I'm going to now take a few questions, then we can have a general discussion. So one question asked by Jenny is, technology stocks have dropped 30%. Is it a good time to invest in technology funds? Okay, I don't know why I didn't mention Alibaba and Baidu of China. So there are a few China technology stocks that have dropped a lot. Maybe but they are also traded in Hong Kong. So my preference is still the technology stocks in China for all the reasons listed here. Low PE ratio, high dividend yield. So you take a look at these are technology stocks, SMIC, ZTE. There should be, I think, Alibaba and Baidu. Maybe these are listed in Hong Kong, but not in China. So I will prepare another table of those other stocks that seem to be quite good technology stocks. Will I invest in technology now? I probably will not. I think the PE ratios are still too high. The US technology stocks, the PE ratio are still too high, dividend too low. I might as well invest in the stocks here where the reasons I've given. And even if I want technology, recently Alibaba and Baidu have moved up a lot, maybe about 20-30%. I'm still showing a loss on what I invested in Alibaba and Baidu, but the loss is diminishing. So it might be a better choice. Why is there a discount in the first place? You see, these are China stocks, and they are listed in Shanghai or Shenzhen. And China investors buy these stocks. And these are the prices. These are the prices paid by the China investors. And these companies also list in Hong Kong. The same stocks, maybe half they list in China, half in Hong Kong, or maybe 3/4 in China, 1/4 in Hong Kong. So their shares, they will put the larger part maybe in China, but still a significant proportion they put in Hong Kong. And some of them put some of the shares in America. So they list in Hong Kong, America, and China. The China listed, only the China people can buy that. The Hong Kong and American listing is for foreigners to buy. And then the last 2 years, the US government had put pressure on the listing of China, on the China stocks listed in America. So several of them are now moving from America to Hong Kong. So why are the prices in Hong Kong lower than in Shanghai? The reason is the investors, the international investors, they don't have a confidence in China. So they sell their stocks and the price become very low and you get this huge discount. They don't have confidence in China. For me, I follow China very closely. I follow their politics, their governance, their economy, their technology. I follow very closely. And I find that their companies are very good, very innovative. Their market is very good. Their profits are very good. So the prices are Hong Kong, at the prices in Hong Kong, I find that they are very attractive. Of course, if I have to pay the higher price in Shanghai, they are not so attractive. So I wouldn't pay the higher price in Shanghai. But at the discount in Hong Kong is extremely attractive. Will I change my mind when the discount disappear and the Hong Kong price move up to the Shanghai price? Maybe I won't be that interested. So this discount is a very big factor. Now, I mentioned that Ping An. All along, I didn't invest in Ping An because there was no discount. And the Ping An, if you take a look, P/E ratio 8.8 is attractive, but not very attractive. But Ping An dropped 76%, dropped 24% over the last 1 year, 24%. Actually, the drop was higher. At one point, it was dropped 50%. It has since recovered half of the drop. But I bought some of the shares when it was at the low point. So I'm making quite a good profit on Ping An. I didn't buy Ping An because there was no discount and the price was quite not that attractive. It's okay, but not attractive. But when Ping An dropped 50% earlier this year, I bought some shares and now it has gone up, recovered half the loss. So that's the reason. I'm now going to close the recording. And if you wish to have some general discussion, you can still type in the group chat or you can open up your audio. I'm going to unmute everybody. You can ask your question by the audio. So let's close this.